Hi, it's Michael Farr from Farr, Miller, and Washington. Thanks for joining me again this week. The Federal Reserve last Thursday came out and did nothing. How about that? And markets haven't liked it. They haven't liked it for two reasons. One, because with all of the noise that the Fed was making about going ahead and raising rates, when they actually came up to the precipice of taking some sort of action, when they stared over that cliff of the economy and looked lower, they said, and they balked. They did not think that economic conditions were strong enough to increase rates at this time. After all of the noise, after all of the jawboning, they balked. And that's worried markets. Markets have said, wait a minute. Now the Fed is saying as much as they wanted to, they couldn't do it because economic conditions were too weak. Investors have been voting with their feet, and stock prices have gone lower. They went substantially lower on Friday. They're down another couple of hundred points today. 16,310 on the Dow, 1943 on the S&P 500, down 23 points. Other numbers we watch very closely, of course, the 10-year Treasury note is at 2.14%. Crude oil is 45.83. That's off a little bit. Bond prices are higher. 2.14 is a good deal lower than when we spoke last week. And the euro versus the dollar is lower. So the dollar is higher. It's now $1.11 to buy a euro. That's pretty low. I told you, I had a good time in Italy, and they have to go back if these rates keep up. We look at the economy to determine what sort of investing environment we may have. If the economy is expanding, if new businesses are opening, if people have more jobs and more money to spend, that bodes well for earnings for broad corporate America, and that, of course, translates into good results for investors. As I look at the economy, sometimes I share a lot of the data we look at in unemployment and other things with you. I looked at three stories on CNBC overnight. How much retirement, how much you really need for retirement, renters getting ready to take it on the chin, and Chase Mortgage CEO red flags FHA loans. These are all related, and I'm going to tell you why. We've been saying that one of the headwinds to the economy is that people haven't saved enough for retirement. The old rule said that you needed $1 million to retire at least. In 2008, I actually wrote a book about it. $1 million's not enough. That was 7 years ago. I suggested $1 million's not enough. Indeed, at the beginning of this year, Legg Mason came out and suggested that $2.5 million might be the right number. 1 in 10 workers think that $1.5 million will be enough for them. Why are those numbers a problem for the markets? Because the average household of aged 55 to 64, the average household in this country aged 55 to 64 has $104,000 in retirement savings. The average household 65 to 74 has an average of $148,000 in retirement savings. So whether the number's $500,000 or $1 million or even $2.5 million, as Legg Mason suggests, people are undersaved, which means they've got to really save more vigilantly or they've got to work a lot longer, and they likely have to do both. If they're saving, they're not spending. If they're saving, they're not consuming, and they're not out there spending. That's a headwind to an economy trying to recover. Rents. 12 million Americans right now spend 50% of their incomes on rent. According to a survey and an article on CNBC, that number of Americans is going to increase, and the cost for those rents are going to increase by 11% over the next 10 years. 50% of your income just on rent. That doesn't mean you have a lot of money to do much else. Another headwind. Finally, J.P. Morgan Chase has said they're not interested in doing FHA loans anymore. The requirements for FHA loans, we should all get such a deal. You need a 520 credit score, FICO score of 520. And you have to make a 3.5% down payment. So Somebody's going to come to you with a very bad credit score of 520. I would not want to loan money to a person. And then for a $100,000 house, they have to put down $3,500, and you're going to loan them the rest based on a 520 credit score. So the banks don't want to make these loans, which means a lot of first-time home buyers are going to have a more difficult time buying. And maybe they should. But, again, if they're not able to get out there and consume and buy and do these things, economic growth is going to be sluggish. That's been something I've been suggesting to you viewers and our readers for some time, certainly CNBC viewers when I have been on these past few years. The economy's recovering. It's a slow growth recovery. The Fed pretty much has told us that yet again. Markets don't like to hear it. It doesn't mean the end of the world. It does mean that you should know what you own and why you own it. If you need a little help, give us a call at Farr, Miller & Washington. I've said before, you need to make sure that you have a seat when the music stops. I'm not predicting any great stop to the music or any great correction. But if we are in slow growth, and I think we will be for a while, and I think interest rates are going to stay low for a very long while, that's what the Fed's told us too, then make sure that you own things that are able to grow, able to earn, and help your investments increase over time without inappropriate amounts of risk. Thanks so much for tuning in again. If we can help you, call us in Washington, D.C. I'm Michael Farr.